Welcome to another edition, Coffee with Kirk. I hope you had a fantastic 4th of July. I know it's pretty much hot everywhere, at least on the East Coast. Went for a run this morning and thought I was down in Florida when I did it. Anyway, if you could, I was having issues with my mic this morning. So if I sound funky or if you can't hear me quite right, could you throw it in the chat box? I think it's working, but it may not be. So if it's not working, just let me know. I'll try to figure it out. Anyway, I've got a shorter presentation today that I'm going to do, and then I'm going to show a video that I think is pretty informative. Mine's been shortened mostly because I had a few questions from people about the Chevron case that the Supreme Court just ruled on. And I had every intention to kind of spend some time on the holiday, 4th of July holiday, sitting around reading, putting together some thoughts on it, maybe trying to project how could it affect, everything. It's basically going to affect every industry to some degree because every industry has the massive amount of regulation, some more than others. So how's that going to have an impact and what could possibly happen with it? Ultimately, I'm very happy that they finally passed something like, the Supreme Court finally ruled that, we can't be run by unelected bureaucrats. But could be some interesting moves coming up. So we'll see. So I'm going to try to present on that next time. I just ended up going down a couple rabbit holes on the holiday. One of them about just training. I'm going to try to do a half marathon in October and end up going down that rabbit hole. And then I also spent quite a bit of time just finishing up the book on John Adams by David McCullough. And I guess that was appropriate for the 4th of July to be reading about one of our founding fathers. But man, what a great book. If you haven't read that, David McCullough is just unbelievable writer. Just almost makes you feel like you're reading a fictitious story, the way he develops the characters, the events, how they react to them. History classes had been like that throughout junior high, high school. We probably have a much smarter populace because it's rather than memorizing dates, it's actually really getting to feel like you're in the middle of a movie or a good fiction book. Anyway, I guess I'm just rambling here, but I'm going to just kind of hit on one little topic that I was looking at, and then we'll just jump to a video. It's by Ray Dalio, and I've always kind of liked this video, so I thought, I'll just sort of play this. It's more of a big picture economic book or video. So anyway, let's start off real quick. Let me jump into my slides like I always seem to like to do. So the big thing I've been talking about really for this whole year is I can't make heads or tails of really which way this economy's headed. It seems like sometimes, everything says, oh man, it's, everything is just headed to kind of a deflationary environment, slow down, everything pointing to, maybe recession or close to recession. And then there's periods where I'll look and say, oh, well, it looks like inflation's really starting to rear its ugly head here again, like accelerating. And it happens frequently. And the way I always try to plug things in is to look at a model with 4 different quadrants. And if you can kind of focus on where we're at, if you can understand it, it really can help drive your decisions. And it really just looks at 2 different factors. 1, economic growth, and then 2, inflation. So you're trying to understand, is the economy expanding? Is it growing faster? Is it getting to the point where the economy is growing at a faster pace? Or is it slowing down? Which way are things headed? And it doesn't necessarily mean is it growing at all. It's just, all right, we look back at previous quarters. Are we accelerating or are we decelerating? And the same for inflation. Is inflation accelerating or is it decelerating? So even if inflation's above the 2% that the Fed wants, like it is right now, roughly anywhere from 3.4 to 3.8. So that's typically higher than what we've experienced the past couple of decades. So we still have high inflation, but if it's decelerating, that also kind of tells you where you're at in these quads. So quad 1 is kind of the best place to be because you've got an economy that's actually accelerating in growth, but you have moderating or reducing inflation. So that's the perfect spot that you want to be in. Quad 1 is where ideally you want to be. So in that kind of situation, what you're going to really want to focus on, stocks are going to be a great place to be. Higher yield credit. So some more junk bond kind of stuff. Some of the assets you don't want to be in is going to be more of a fixed income, meaning like good treasuries or high quality corporates or mortgage backed. The sectors that are going to do well in that situation are technology, consumer discretionary because the economy is growing, industrials because the economy is growing. Sectors that are going to struggle are going to be utilities, staples, and energy. So that's what you're looking for in that kind of perfect quad. And, if you look at technology right now, it's saying, look, in fact, technology is acting like we are in quad 1. We do have moderating inflation relative to where it was maybe in 2022. And, it says that we've got some growth. So that's what tech stocks are doing. But I think tech stocks are just acting more like a bubble. So now we move from quad 1 to quad 2. Quad 2 still sees economic growth accelerating. But what you also see in quad 2 is inflation accelerating. So you could have a period where you are growing, but the cost to do that growth is also going up. And this isn't necessarily a bad area to be either. And in fact, you could make the argument that if the economy is growing, then there's probably going to be more inflation just because there's more economic activity, right? More demand for goods and services, and maybe the supply isn't keeping pace quite as bit, so you're going to have some inflation, but you still have that underlying demand. So here again in quad 2, stocks and higher, I guess lower rated bonds, credit quality bonds are the place to be. The safer fixed income is not the place to be. You still want the same kind of sectors. Technology is going to do well there. Industrials, consumer discretionary is going to do well. But when you have inflation going up, it does change a little bit the sectors that don't do as well. So utilities aren't going to do as well in both quad 1, quad 2. Consumer staples aren't going to do well in quad 1 or quad 2. And then real estate investment trusts aren't going to do well. So inflation is going to hurt real estate investment trusts because a lot of that is based on the dividend yield that they're kicking off. And if inflation's going up, it's going to effectively reduce the power of that dividend. But energy is, while it's something you don't want to be in quad 1 with reduced inflation, it is actually a pretty good sector to be invested in quad 2 because we have inflation accelerating. Now, the last 2 quads are where you start to see some of the bad stuff, right? So quad 3 is what we would call stagflation. This is where you're going to actually have growth decelerating in the economy, but inflation is accelerating. So you've kind of got a bad situation where inflation's going up, but growth's coming down. And this is what you saw in the 70s and early 80s. You saw this quite a bit. So in this situation, where do you want to be? Fixed income, the higher quality treasuries, triple, AA corporates, those are going to be a very good place to be. Stocks and credit aren't going to be that great. Sector-wise, you do want to be in utilities, real estate investment trust, and energy. So both utilities and REITs, while they were bad in quad 2, they're actually good in quad 3. And you say, well, the inflation made REITs bad in quad 2. Why are they good in quad 3? Well, it's mostly because you now have a shrinking economy. So the revenues that they are getting are all of a sudden a little bit more reliable. And then the other good sector to be in there is energy. So energy is good in quad 3 because we have inflation. Bad areas, financials, consumer staples, and materials. So materials are kind of they're leading the industrial part. I would throw industrials in there too in quad 3. But definitely the materials would be bad because a lot of those are raw goods, so that price are going up, and materials then lead to the industrials. So with the economy shrinking, less demand on the industrial side for the materials. Okay, and then you have quad 4. Most people would say quad 4 is the worst because you have both shrinking economic growth and prices. So this is kind of what you see in most recessions. The 1970s were sort of an exception to that, but if you go back to the Great Depression and the year 2000 to 2002, 2008, every other recession is basically a point where you have both of them shrinking. So prices are coming down just because demand on the economic side has collapsed. So in this situation, you definitely want to have some fixed income, real high quality treasuries, corporates. Stocks are going to be really bad. Junk bonds are going to be bad. Sectors that are going to be probably pretty good here. Healthcare, consumer staples. I would add utilities in here. Materials as well. Sectors that are going to be bad are going to be tech, energy, industrials. So at that point, you want to really focus on really high quality stuff. So, this year, we've been bouncing quad 2 or quad 3, quad 4. Some people make the case of quad 1. It looked like at the end of 23, we were probably heading into a quad 1. We did see the last 2 quarters of GDP growth start to grow up. So acceleration from prior quarters. And while inflation was still higher than normal, it was pulling back a little bit from the peaks. So, the market was kind of looking at a quad 1 and expecting some rate cuts because of that. But really, quad 3 and quad 4 have been sort of where I've been fighting. As soon as I think, all right, yeah, it looks like a quad 4, we're slowing down economically, and prices are moderating a little bit more, but then something happens, quad 3 comes back into play. So it is clear we're starting to see GDP slowing. So this is basically back through the fourth quarter of 2022. You can see first part of 23, we were actually seeing year over year decline or slowing of GDP. But then the last 2 quarters, it actually accelerated. But now we've dropped quite a bit back again for the first quarter, and it was at 1.4%. And right now, if things hold, we should get this number soon, but most economists are expecting about a 1.7% growth here for the second quarter, but we'll see shortly. So things are definitely slowing on the GDP side. So that, in my mind, puts us in quad 3 or quad 4. And usually what you try to look to see that, I've always said on here, the smart money is the bond market, right? The stock market's kind of like the dog that it's either really happy or, really sad, or, it just kind of goes around without thinking a whole lot. But the bond market, it's the smart money. So this is the 10-year yield, the U.S. Treasury. And this is just year to date on it. So you can kind of see the longer term trends on it. So really, if we from probably February up until May, we had yields going up. So at that point, I'm like, oh yeah, we're definitely in quad 3. So we have some stagflation going on here. something's really going, kind of awry when the bond yield on the 10-year went from 4.1 to about 4.7. But then, it started to moderate. It came back quite a bit from 4.7 down to about 4.3. So you start to think, well, and let me tell you, that's a big move. That's a sizable move for treasuries. It may not seem like much, 0.5%, 0.3% here. That doesn't seem like it, but that is a big move when you're talking about an asset class like treasuries. The 10-year treasury is tied to pretty much everything, mortgage rates, credit card rates, all of that. So when you have a lot of volatility there, you're going to get volatility in other assets too. So these are big moves. This is the market early on saying, yeah, inflation's coming back. Get ready. And then it rapidly comes back down. It says, no, false alarm. We're actually looking at some deflationary. But then you can see even once it got to 4.3, we had another jump up, back up to about 4.6. Again, 0.2 doesn't seem like a lot, but in less than a month, that's a pretty big move in treasuries. But then as soon as that happens, it comes right back down. Oh, okay, no, quad 4. Usually you get a pretty good tell, and there's a consistent slower chart when you look at the 10-year. So it's coming back down, and then really just a couple of weeks ago, it started to climb quite a bit again. So we went from that roughly 4.2 up to about 4.5. Short order, right? 2 weeks. That's a pretty big move. So the economy now is saying, hey, looks like inflation's coming back. But then just this last week, we had a big move down from 4.5 to 4.28. Again, in a week, that's a big move. It sounds like a rounding error for most people. But for the key benchmark that the economy sort of runs on, that's a really sizable move. So if you talked to me last week, if I did this presentation, I'd say, yeah, it looks like inflation's starting to rear its ugly head. But this week, it's like, well, wait a minute. We got some pretty, I wouldn't say they're awful job numbers, but they weren't very good. So the headline looked okay. 206,000 jobs were added last month. That sounds great. But they revised down the previous 2 months by 110,000 jobs. So that's a really big revision. So they're starting to see there is some slack in the job market. So now bonds are starting to say, well, maybe we're heading into a deflationary environment, which is probably going to mean the Fed is going to cut rates. So bond yields started to come down. And if you look at it, again, just to show you the volatility in it, this is only the 2-year yield. So this should be even less volatile than the 10-year. And if this is just over the last 5 days to see what kind of transpired. So if you look to the far left, it's coming up. And if I showed you the 5 days previous to this, it went radically up. But then the last 5 days, you can see this is a big move down for the 2-year. This is even bigger. So this thing went from about 4.8 to just at close to 4.6%, 0.2 in 5 days. That's a big move. So it's saying, hey, deflation, Fed's going to be cutting. We're slowing down. The economy's slowing. So if we are in the deflation, then I need to start thinking about moving from T-bills, where we have most of our cash, getting 5.24, and then start to move it over into a little bit longer dated treasuries. And you go, why would you do that? 5.24, but the 2 years at 4.6, that's less money. But the thing is, you get capital appreciation as these bonds come down. So if we are in deflation and this is going to go to 3.5, maybe 3, you can actually get capital appreciation on longer dated bonds. And if the Fed starts to lower rates, then the T-bills are going to come from 5.24 down to wherever the Fed basically brings it. And if you look historically, most of the time, the Fed tends to, it's a little bit delayed, but it tends to track the 2-year treasury. So the 2-year treasury is saying that the Fed's probably going to be at about 4.6% here shortly. We'll see. I don't know. It's like every time you think we're heading sort of a deflationary environment, something happens that kind of keeps the Fed on hold. And one of them is oil. So here is the chart so far this year for oil. So we've got crude in the first part of the year went up from about 75 to 86. Inflationary, right? That it kind of matched up with the 10-year treasury. You look at the first part, you say, look, there's inflation. We got to position ourselves for inflation. And then it just kind of essentially went right back down to where it was. So 86 to about 73. Now, moves like that for oil, while a chart like that for treasuries would scare you, for oil is a very volatile asset class. So this is not unusual for oil. But once we got back to that 73 mark, all of a sudden oil took back up and now has essentially moved up to past 83. So, okay, now oil's saying there's inflation coming. Well, is there or is there not? Now, I'm going to show you the 5-day for crude oil, and you can see again for most of the past 5 days, pretty sizable moves up. It's not saying, look, inflation's coming. But then when the jobs number released, I took a pretty big dive from about 84.50 a barrel to 83.30 a barrel. That's a pretty big move for one day. So is that a trend? Not yet. No, one day is certainly not a trend in both treasuries and oil. But as soon as you start to think you've got it figured out, it's throwing you for a loop. Same with commodities in general. This is the holding we have, the Bloomberg All Commodity, 24 most liquid commodities out there. And they kind of went sideways for the first part of the year. And then all of a sudden it said, hey, here comes inflation, baby. We had copper going up. We had lumber going up. Had oil going up. The only thing that was kind of holding it back, natural gas has been in a downturn the whole year so far. So it looked like inflation up until very recently, and then things have pulled back again. So maybe we are heading into sort of a quad 4 situation, lower growth economically and lower prices. But then again, you look at kind of the bellwethers, gold and silver. Pretty much the whole year has been great for both of these. Gold's still kind of chugging right along. So it's been interesting. Usually gold, the dollar, treasuries, inversely correlated. Gold's inversely correlated. So when treasuries start to go up and people can get a higher yield, gold struggles, but that has not been the case this year. And pretty much the same with silver. So you would think if we were heading into deflation, you can see the last little tail of both gold and silver. If we're going into a deflation, typically you'd think the price of both of those would come down, but they're going up. So is that saying inflation, or is it more of a tale of what's going on with the economy? And it's saying, gold has always been kind of an insurance policy from chaos. It's going to take some more time, but it's been a tricky year thus far. Now, as I said, basically tech has been positioned and acting like everything's Goldilocks. We're in quad 1 and things are great. But I think what I've been showing the past few Coffee with Kirks is I think tech is more of it's a bubble. It's just looking like a bubble. So this chart is just showing you the S&P 500 technology sector divided by the S&P 500 overall. And right now as a percentage of the total market, it's far exceeded the peak it hit in the year 2000, in 1999, 2000. Is that normal? It just doesn't feel like it is. And the other thing that's kind of, I've shown charts of NVIDIA versus Cisco, NVIDIA versus Enron, and, people keep saying that's not really all that fair to do it. But here's a chart that's interesting. The percentage of our GDP. So NVIDIA's stock valuation right now matches 11.7% of our GDP. Remember, GDP is everything that our economy produces. So it's going to be publicly traded companies, but it's also all the non-publicly traded, small businesses, mid-sized businesses, everything like that. Lemonade stands that kids are doing. That's the GDP. So it's saying NVIDIA is worth more than 10% of our entire economy. And even Cisco at its peak, when it was ridiculously overvalued, it was at 5.5% of GDP. And even that was just nutty. So, is NVIDIA really going to change the world like that, where it's worth 10% of our entire economic output? I don't think so. I just don't see it. Another chart just kind of showing you at the tech bubble, the top 10 stocks, what they made up as a percentage of GDP. Overall, they were probably about 25% of our GDP. So 10 stocks were 25%. Today, we're at 60%. So are these 10 companies worth 60% of our overall economic activity? Man, if they are, then we truly have entered uncharted waters. And then just the last presentation or two presentations ago, I talked about Warren Buffett, arguably the greatest investor ever. But it took NVIDIA 30 days to go from a $2 trillion company to a $3 trillion. That's a lot of volatility for a company that large. But it took Berkshire Hathaway, took Buffett about 60 years just to get just shy of $1 trillion. So the world's greatest investor still hasn't gotten to $1 trillion, but NVIDIA has gotten to $3 trillion, with $1 full trillion of that coming in over 30 days. So, I don't know when this ends. Could it get even crazier? Absolutely. But if you're sitting in this thing, you got to be smart enough to know when to get out, because when these things turn, they turn fast. So I've been just avoiding them, honestly, to my detriment so far this year. But as far as volatility, it's going to get ugly when these things finally turn. And just to show you, it's a very narrow market. Right now, the number of stocks outperforming the S&P 500 is about 25%. Now, in a normal statistical, you should have 50% outperforming, 50% not underperforming. That makes up kind of a normal market. 50% should be above the average, 50% should be below. But when you have so few that are actually up over what the market is, that tells you have very low breadth. It's a market that's really tied to such a narrow group of stocks. So that's just a little bit alarming in my eyes. Okay. So I always finish off with the good old disclaimer there. But I'm also going to show this video. It's Ray Dalio just talking about essentially how the economy works, and then what happens when something steps in, mainly too much debt. What happens when we get over indebted? How do you navigate that? So I'll show a little bit of this. I may not show the whole thing, but let me just plug in here and start this.
How the economic machine works in 30 minutes. The economy works like a simple machine, but many people don't understand it, or they don't agree on how it works, and this has led to a lot of needless economic suffering. I feel a deep sense of responsibility to share my simple but practical economic template. Though it's unconventional, it has helped me to anticipate and to sidestep the global financial crisis, and it has worked well for me for over 30 years. Let's begin. Though the economy might seem complex, it works in a simple mechanical way. It's made up of a few simple parts and a lot of simple transactions that are repeated over and over again a zillion times. These transactions are above all else driven by human nature, and they create three main forces that drive the economy. Number one, productivity growth. Number two, the short-term debt cycle. And number three, the long-term debt cycle. We'll look at these three forces and how laying them on top of each other creates a good template for tracking economic movements and figuring out what's happening now. Let's start with the simplest part of the economy, transactions. An economy is simply the sum of the transactions that make it up, and a transaction is a very simple thing. You make transactions all the time. Every time you buy something, you create a transaction. Each transaction consists of a buyer exchanging money or credit with a seller for goods, services, or financial assets. Credit spends just like money, so adding together the money spent and the amount of credit spent, you can know the total spending. The total amount of spending drives the economy. If you divide the amount spent by the quantity sold, you get the price. And that's it. That's a transaction. It's the building block of the economic machine. All cycles and all forces in an economy are driven by transactions. So, if we can understand transactions, we can understand the whole economy. A market consists of all the buyers and all the sellers making transactions for the same thing. For example, there is a wheat market, a car market, a stock market, and markets for millions of things. An economy consists of all of the transactions in all of its markets. If you add up the total spending and the total quantity sold in all of the markets, you have everything you need to know to understand the economy. It's just that simple. People, businesses, banks, and governments all engage in transactions the way I just described, exchanging money and credit for goods, services, and financial assets. The biggest buyer and seller is the government, which consists of two important parts: a central government that collects taxes and spends money, and a central bank, which is different from other buyers and sellers because it controls the amount of money and credit in the economy. It does this by influencing interest rates and printing new money. For these reasons, as we'll see, the central bank is an important player in the flow of credit. I want you to pay attention to credit. Credit is the most important part of the economy and probably the least understood. It's the most important part because it's the biggest and most volatile part. Just like buyers and sellers go to the market to make transactions, so do lenders and borrowers. Lenders usually want to make their money into more money, and borrowers usually want to buy something they can't afford, like a house or a car, or they want to invest in something like starting a business. Credit can help both lenders and borrowers get what they want. Borrowers promise to repay the amount they borrow, called principal, plus an additional amount, called interest. When interest rates are high, there is less borrowing because it's expensive. When interest rates are low, borrowing increases because it's cheaper. When borrowers promise to repay and lenders believe them, credit is created. Any two people can agree to create credit out of thin air. That seems simple enough, but credit is tricky because it has different names. As soon as credit is created, it immediately turns into debt. Debt is both an asset to the lender and a liability to the borrower. In the future, when the borrower repays the loan plus interest, the asset and the liability disappear and the transaction is settled. So why is credit so important? Because when a borrower receives credit, he is able to increase his spending. And remember, spending drives the economy. This is because one person's spending is another person's income. Think about it. Every dollar you spend, someone else earns, and every dollar you earn, someone else has spent. So when you spend more, someone else earns more. When someone's income rises, it makes lenders more willing to lend him money because now he's more worthy of credit. A credit-worthy borrower has two things: the ability to repay and collateral. Having a lot of income in relation to his debt gives him the ability to repay. In the event that he can't repay, he has valuable assets to use as collateral that can be sold. This makes lenders feel comfortable lending him money. So increased income allows increased borrowing, which allows increased spending. And since one person's spending is another person's income, this leads to more increased borrowing, and so on. This self-reinforcing pattern leads to economic growth and is why we have cycles. In a transaction, you have to give something in order to get something. And how much you get depends on how much you produce. Over time, we learn, and that accumulated knowledge raises our living standards. We call this productivity growth. Those who are inventive and hardworking raise their productivity and their living standards faster than those who are complacent and lazy. But that isn't necessarily true over the short run. Productivity matters most in the long run, but credit matters most in the short run. This is because productivity growth doesn't fluctuate much, so it's not a big driver of economic swings. Debt is, because it allows us to consume more than we produce when we acquire it, and it forces us to consume less than we produce when we have to pay it back. Debt swings occur in two big cycles. One takes about 5 to 8 years, and the other takes about 75 to 100 years. While most people feel the swings, they typically don't see them as cycles because they see them too up close, day by day, week by week. In this chapter, we're going to step back and look at these three big forces and how they interact to make up our experiences. As mentioned, swings around the line are not due to how much innovation or hard work there is. They're primarily due to how much credit there is. Let's for a second imagine an economy without credit. In this economy, the only way I can increase my spending is to increase my income, which requires me to be more productive and do more work. Increased productivity is the only way for growth. Since my spending is another person's income, the economy grows every time I or anyone else is more productive. If we follow the transactions and play this out, we see a progression like the productivity growth line. But because we borrow, we have cycles. This isn't due to any laws or regulations. It's due to human nature and the way that credit works. Think of borrowing as simply a way of pulling spending forward. In order to buy something you can't afford, you need to spend more than you make. To do this, you essentially need to borrow from your future self. In doing so, you create a time in the future that you need to spend less than you make in order to pay it back. It very quickly resembles a cycle. Basically, anytime you borrow, you create a cycle. This is as true for an individual as it is for the economy. This is why understanding credit is so important, because it sets into motion a mechanical, predictable series of events that will happen in the future. This makes credit different from money. Money is what you settle transactions with. When you buy a beer from a bartender with cash, the transaction is settled immediately. But when you buy a beer with credit, it's like starting a bar tab. You're saying you promise to pay in the future. Together, you and the bartender create an asset and a liability. You just created credit out of thin air. It's not until you pay the bar tab later that the asset and the liability disappear, the debt goes away, and the transaction is settled. The reality is that most of what people call money is actually credit. The total amount of credit in the United States is about $50 trillion, and the total amount of money is only about $3 trillion. Remember, in an economy without credit, the only way to increase your spending is to produce more. But in an economy with credit, you can also increase your spending by borrowing. As a result, an economy with credit has more spending and allows incomes to rise faster than productivity over the short run, but not over the long run. Now, don't get me wrong. Credit isn't necessarily something bad that just causes cycles. It's bad when it finances overconsumption that can't be paid back. However, it's good when it efficiently allocates resources and produces income so you can pay back the debt. For example, if you borrow money to buy a big TV, it doesn't generate income for you to pay back the debt. But if you borrow money to, say, buy a tractor, and that tractor lets you harvest more crops and earn more money, then you can pay back your debt and improve your living standards. In an economy with credit, we can follow the transactions and see how credit creates growth. Let me give you an example. Suppose you earn $100,000 a year and have no debt. You are creditworthy enough to borrow $10,000, say on a credit card. So you can spend $110,000 even though you only earn $100,000. Since your spending is another person's income, someone is earning $110,000. The person earning $110,000 with no debt can borrow $11,000, so he can spend $121,000, even though he has only earned $110,000. His spending is another person's income, and by following the transactions, we can begin to see how this process works in a self-reinforcing pattern. But remember, borrowing creates cycles, and if the cycle goes up, it eventually needs to come down. This leads us into the short-term debt cycle. As economic activity increases, we see an expansion, the first phase of the short-term debt cycle. Spending continues to increase and prices start to rise. This happens because the increase in spending is fueled by credit, which can be created instantly out of thin air. When the amount of spending and incomes grow faster than the production of goods, prices rise. When prices rise, we call this inflation. The central bank doesn't want too much inflation because it causes problems. Seeing prices rise, it raises interest rates. With higher interest rates, fewer people can afford to borrow money, and the cost of existing debts rises. Think about this as the monthly payments on your credit card going up. Because people borrow less and have higher debt repayments, they have less money left over to spend, so spending slows. And since one person's spending is another person's income, incomes drop, and so on and so forth. When people spend less, prices go down. We call this deflation. Economic activity decreases, and we have a recession. If the recession becomes too severe and inflation is no longer a problem, the central bank will lower interest rates to cause everything to pick up again. With low interest rates, debt repayments are reduced and borrowing and spending pick up, and we see another expansion. As you can see, the economy works like a machine. In the short-term debt cycle, spending is constrained only by the willingness of lenders and borrowers to provide and receive credit. When credit is easily available, there's an economic expansion. When credit isn't easily available, there's a recession. And note that this cycle is controlled primarily by the central bank. The short-term debt cycle typically lasts 5 to 8 years and happens over and over again for decades. But notice that the bottom and top of each cycle finish with more growth than the previous cycle and with more debt. Why? Because people push it. They have an inclination to borrow and spend more instead of paying back debt. It's human nature. Because of this, over long periods of time, debts rise faster than incomes, creating the long-term debt cycle. Despite people becoming more indebted, lenders even more freely extend credit. Why? Because everyone thinks things are going great. People are just focused on what's been happening lately. And what's been happening lately? Incomes have been rising. Asset values are going up. The stock market roars. It's a boom. It pays to buy goods, services, and financial assets with borrowed money. When people do a lot of that, we call it a bubble. So even though debts have been growing, incomes have been growing nearly as fast to offset them. Let's call the ratio of debt to income the debt burden. So long as incomes continue to rise, the debt burden stays manageable. At the same time, asset values soar. People borrow huge amounts of money to buy assets as investments, causing their prices to rise even higher. People feel wealthy. So even with the accumulation of lots of debt, rising incomes and asset values help borrowers remain creditworthy for a long time. But this obviously cannot continue forever. And it doesn't. Over decades, debt burdens slowly increase, creating larger and larger debt repayments. At some point, debt repayments start growing faster than incomes, forcing people to cut back on their spending. And since one person's spending is another person's income, incomes begin to go down, which makes people less creditworthy, causing borrowing to go down. Debt repayments continue to rise, which makes spending drop even further. And the cycle reverses itself. This is the long-term debt peak. Debt burdens have simply become too big. For the United States, Europe, and much of the rest of the world, this happened in 2008. It happened for the same reason it happened in Japan in 1989 and in the United States back in 1929. Now the economy begins deleveraging. In a deleveraging, people cut spending, incomes fall, credit disappears, asset prices drop, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself the other way. As incomes fall and debt repayments rise, borrowers get squeezed. No longer creditworthy, credit dries up, and borrowers can no longer borrow enough money to make their debt repayments. Scrambling to fill this hole, borrowers are forced to sell assets. The rush to sell assets floods the market at the same time as spending falls. This is when the stock market collapses, the real estate market tanks, and banks get into trouble. As asset prices drop, the value of the collateral borrowers can put up drops. This makes borrowers even less creditworthy. People feel poor. Credit rapidly disappears. Less spending, less income, less wealth, less credit, less borrowing, and so on. It's a vicious cycle. This appears similar to a recession, but the difference here is that interest rates can't be lowered to save the day. In a recession, lowering interest rates works to stimulate borrowing. However, in a deleveraging, lowering interest rates doesn't work because interest rates are already low and soon hit 0%, so the stimulation ends. Interest rates in the United States hit 0% during the deleveraging of the 1930s and again in 2008. The difference between a recession and a deleveraging is that in a deleveraging, borrowers' debt burdens have simply gotten too big and can't be relieved by lowering interest rates. Lenders realize that debts have become too large to ever be fully paid back. Borrowers have lost their ability to repay and their collateral has lost value. They feel crippled by the debt. They don't even want more. Lenders stop lending, borrowers stop borrowing. Think of the economy as being not creditworthy, just like an individual. So what do you do about a deleveraging? The problem is debt burdens are too high and they must come down. There are 4 ways this can happen. 1. People, businesses, and governments cut their spending. 2. Debts are reduced through defaults and restructurings. 3. Wealth is redistributed from the haves to the have-nots. And finally, 4. The central bank prints new money. These 4 ways have happened in every deleveraging in modern history. Usually, spending is cut first. As we just saw, people, businesses, and even governments tighten their belts and cut their spending so that they can pay down their debt. This is often referred to as austerity. When borrowers stop taking on new debts and start paying down old debts, you might expect the debt burden to decrease. But the opposite happens. Because spending is cut, and one man's spending is another man's income, it causes incomes to fall. They fall faster than debts are repaid, and the debt burden actually gets worse. As we've seen, this cut in spending is deflationary and painful. Businesses are forced to cut costs, which means less jobs and higher unemployment. This leads to the next step. Debts must be reduced. Many borrowers find themselves unable to repay their loans, and a borrower's debts are a lender's assets. When a borrower doesn't repay the bank, people get nervous that the bank won't be able to repay them, so they rush to withdraw their money from the bank. Banks get squeezed, and people, businesses, and banks default on their debts. This severe economic contraction is a depression. A big part of a depression is people discovering much of what they thought was their wealth isn't really there. Let's go back to the bar. When you bought a beer and put it on a bar tab, you promised to repay the bartender. Your promise became an asset of the bartender. But if you break your promise, if you don't pay him back and essentially default on your bar tab, then the asset he has isn't really worth anything. It has basically disappeared. Many lenders don't want their assets to disappear and agree to debt restructuring. Debt restructuring means lenders get paid back less, or get paid back over a longer time frame, or at a lower interest rate than was first agreed. Somehow, a contract is broken in a way that reduces debt. Lenders would rather have a little of something than all of nothing. Even though debt disappears, debt restructuring causes income and asset values to disappear faster, so the debt burden continues to get worse. Like cutting spending, debt reduction is also painful and deflationary. All of this impacts the central government because lower incomes and less employment means the government collects fewer taxes. At the same time, it needs to increase its spending because unemployment has risen. Many of the unemployed have inadequate savings and need financial support from the government. Additionally, governments create stimulus plans and increase their spending to make up for the decrease in the economy. Governments' budget deficits explode into deleveraging because they spend more than they earn in taxes. This is what's happening when you hear about the budget deficit on the news. To fund their deficits, governments need to either raise taxes or borrow money. But with incomes falling and so many unemployed, who is the money going to come from? The rich. Since governments need more money and since wealth is heavily concentrated in the hands of a small percentage of the people, governments naturally raise taxes on the wealthy, which facilitates a redistribution of wealth in the economy from the haves to the have-nots. The have-nots who are suffering begin to resent the wealthy haves. The wealthy haves, being squeezed by the weak economy, falling asset prices, and higher taxes, begin to resent the have-nots. If the depression continues, social disorder can break out. Not only do tensions rise within countries, they can rise between countries, especially debtor and creditor countries. This situation can lead to political change that can sometimes be extreme. In the 1930s, this led to Hitler coming to power, war in Europe, and depression in the United States. Pressure to do something to end the depression increases. Remember, most of what people thought was money was actually credit. So when credit disappears, people don't have enough money. People are desperate for money, and you remember who can print money? The central bank can. Having already lowered its interest rates to nearly zero, it's forced to print money. Unlike cutting spending, debt reduction, and wealth redistribution, printing money is inflationary and stimulative. Inevitably, the central bank prints new money out of thin air and uses it to buy financial assets and government bonds. It happened in the United States during the Great Depression, and again in 2008 when the United States Central Bank, the Federal Reserve, printed over $2 trillion. Other central banks around the world that could printed a lot of money too. By buying financial assets with this money, it helps drive up asset prices, which makes people more creditworthy. However, this only helps those who own financial assets. You see, the central bank can print money, but it can only buy financial assets. The central government, on the other hand, can buy goods and services and put money in the hands of the people, but it can't print money. So in order to stimulate the economy, the two must cooperate. By buying government bonds, the central bank essentially lends money to the government, allowing it to run a deficit and increase spending on goods and services through its stimulus programs and unemployment benefits. This increases people's income as well as the government's debt. However, it will lower the economy's total debt burden. This is a very risky time. Policymakers need to balance the four ways that debt burdens come down. The deflationary ways need to balance with the inflationary ways in order to maintain stability. If balanced correctly, there can be a beautiful deleveraging. You see, a deleveraging can be ugly or it can be beautiful. How can a deleveraging be beautiful? Even though a deleveraging is a difficult situation, handling a difficult situation in the best possible way is beautiful. A lot more beautiful than the debt-fueled, unbalanced excesses of the leveraging phase. In a beautiful deleveraging, debts decline relative to income, real economic growth is positive, and inflation isn't a problem. It is achieved by having the right balance. The right balance requires a certain mix of cutting spending, reducing debt, transferring wealth, and printing money so that economic and social stability can be maintained. People ask if printing money will raise inflation. It won't if it offsets falling credit. Remember, spending is what matters. A dollar of spending paid for with money has the same effect on price as a dollar of spending paid for with credit. By printing money, the central bank can make up for the disappearance of credit with an increase in the amount of money. In order to turn things around, the central bank needs to not only pump up income growth, but get the rate of income growth higher than the rate of interest on the accumulated debt. So what do I mean by that? Basically, income needs to grow faster than debt grows. For example, let's assume that a country going through a deleveraging has a debt-to-income ratio of 100%. That means that the amount of debt it has is the same as the amount of income the entire country makes in a year. Now think about the interest rate on that debt. Let's say it's 2%. If debt is growing at 2% because of that interest rate, and income is only growing at around 1%, you will never reduce the debt burden. You need to print enough money to get the rate of income growth above the rate of interest. However, printing money could easily be abused because it's so easy to do and people prefer it to the alternatives. The key is to avoid printing too much money and causing unacceptably high inflation the way Germany did during its deleveraging in the 1920s. If policymakers achieve the right balance, a deleveraging isn't so dramatic. Growth is slow, but debt burdens go down. That's a beautiful deleveraging. When incomes begin to rise, borrowers begin to appear more creditworthy. And when borrowers appear more creditworthy, lenders begin to lend money again. Debt burdens finally begin to fall. Able to borrow money, people can spend more. Eventually, the economy begins to grow again, leading to the reflation phase of the long-term debt cycle. Though the deleveraging process can be horrible if handled badly, if handled well, it will eventually fix the problem. It takes roughly a decade or more for debt burdens to fall and economic activity to get back to normal, hence the term lost decade. In closing, of course, the economy is
Okay, I just stopped it there. I apologize. It looked like this thing was having problems on my end. It wasn't keeping pace. The video wasn't keeping pace with the audio. I don't know if you had the same thing. Hopefully it was okay for what you all saw. Anyway, it's interesting from Ray Dalio. His last conclusion that policymakers can kind of get a beautiful deleveraging. It's never happened, and I don't think it ever will, mostly because they make emotional decisions when things get sticky. Your best bet is always to try to minimize your debt level and increase your asset level on a personal note. And if everybody's doing that, then you don't see the credit ever get to the point where you have busts. Anyway, I hope everybody has a great weekend. And if you have questions, shoot it at me. Like I said, next time we'll get more into more data, but we'll also talk about the Chevron case and discuss that for a bit. So have a great weekend, everyone.